And I think the paper money will go down to zero value. By the time it's over, the world will own gold to a heavier amount. I've seen in the 70s, I remember the typical portfolio allocation was to have 10% of a client's money in gold. That hasn't happened yet.
Mm-hmm.
70% of financial institutions in the US, they own less than 1% in gold.
You're watching Capital Cosm. My name is Danny, and today's guest is the editor and founder of the Gloom, Boom, and Doom Report. It's Dr. Marc Faber. Dr. Marc Faber, thank you so much for coming back on the show, my friend.
It's my pleasure. Thank you very much for having me.
Yeah, for sure. It's a great privilege and pleasure to have you on, especially with all of this news going on, with the tariff and the trade wars and the huge volatility in the markets. I haven't seen anything like this since, I suppose, 2020, back during the COVID crash. But let's go ahead and get your take on all of this. Trump did rescind most of his tariffs that he slapped on, excluding the retaliatory tariffs yesterday. But he did increase the Chinese tariffs up to 125%. Now, what do you make of all this? Was this the plan all along to target China, or was he spooked by something going on in the bond market? Were bond yields going up too high too fast? What's your take on all of this? And we can kind of pick apart details from there.
Well, my take on it is that the current administration in the US is an interventionist administration, including the Treasury Secretary, and but they don't know exactly what the consequences of their actions are, and I think they frequently misread what the consequences will be. So, as an example, the view may have been, yes, we impose these tariffs, but the stock market isn't going to go down, as an example. But suddenly the stock market went down a lot, or they may have introduced the tariffs and they expected bonds to actually rally and not to go down. But no, the bond market went down. So you understand, in economics, it's easy to to intervene into the free market, but you never know precisely what will happen. And quite frankly, I think this administration was very surprised that the stock market went down since the time Trump was elected. And the Treasury Secretary, he was very surprised that bonds didn't rally but went down, because the objective of the Treasury is actually to refinance the debt. They have about $9 trillion coming due this year. So they'd like to refinance it at lower interest rates. But likely what will happen is that they will have to pay higher interest rates than they projected. So it's a mess. And it also shows that Trump basically has no backbone. He takes a measure, the market reacts adversely, so he immediately rescinds the measures he took. It's for foreigners or for international investor, it's not exactly a sign of a strong administration. It's a sign of weakness, actually. And my view would be that the market is going to defy Mr. Trump very badly.
And what happens when the United States has to roll over $9 trillion into a 10-year, into a 10-year yield, effectively priced at over 4%?
Well, the idea was that the interest expense on the government debt would come down, but I think that is out. Mm-hmm. And the the refinancing the cost will be very high, and it will necessitate the central bank actually to print money.
Mm.
And therefore, we have this dollar weakness at the present time. And we have strength in precious metals. I mean, that is the most obvious, that the
Right.
dollar will continue to lose value against precious metals.
Right. So
But
you go ahead.
but to answer your question precisely, the problem with government interventions is that it makes the forecasting even more difficult. Even in a free market, forecasting the future is next to impossible. But when you have the government interventions, and especially by people who have basically no economic knowledge, you understand, these
Mhm.
clowns in government, they're not businessmen per se and so forth that have dealt with multinational corporations and in currencies and in international affairs. They are ignorant people to a large extent, including Mr. Trump. He's not an academic. He's not a great thinker. Actually, for me, as an outside observer, it's almost laughable that someone like Mr. Trump, and I would have voted for him, you don't misunderstand me. I think it's the better option, but it's still distressing that someone like him leads still the most powerful country in the world.
Yes, and so it seems like all roads lead back to money printing, and if they can't, go ahead.
Yes, you said it. All roads lead to money printing. In my view, if you analyze all the options, the other options are far too painful. And therefore, especially under the present administration, they're going to print money. They're going to print money, that's for sure.
Right. And so when we did see these crashing bonds the other day, what was it, that typically defies conventional thinking because usually when the stock market goes down, bonds go up. But it wasn't the case this time around. What was in your analysis, what was different this time around that caused bonds to also crash?
Well, I'm glad you're asking this question because it is true that when the stock market crashes, usually bonds rally. I mean, that is of course, in an asset bubble, interest rates go down and stocks
Mhm.
go up and so forth. So they move in the same direction. But when there is a stock market crash, it is usually, as you said, that bonds rally, but not this time around. And I ask myself the same question: why did it not rally? Why did bonds also continue to go down? First of all, the quality of the debt has deteriorated. So when you analyze bond markets and stocks during stock market crashes like in 2930 or in 2007, 2008, 2009, the junk bonds also go down because the junk bonds, they have a character of equity more so than of a typical bond. And in my view, the treasury market went down partly because of the quality aspect. Number two, I think the market, the international market, realizes that the Fed will have to print money. And the money printing at the present time isn't going to be beneficial for long-term bonds because if you print money in the present time of already existing inflationary pressures, what you're going to do is add to these inflationary pressures down the road. So you don't want to own a 30-year bonds. Maybe you're prepared to own a 2-year bonds because if the Fed eases, They can actually force down interest rates as they did before to zero, or in other countries they had it below zero. So the short end may rally, but not the long end.
Interesting. And what's also interesting is that after Trump declared a 90-day pause on the tariffs, the stock market went ballistic, but the bond market just stayed constant. It didn't, I mean, it pretty much stayed on level. So it doesn't appear like the tariffs had any meaningful change to the interest rates at all.
Not much, but I'd say this. I think, I mean, in the big picture, investors must realize that there are times when the inflationary symptoms manifest themselves in rising consumer price inflation. Rising consumer prices are when food prices go up, when the tickets to a movie go up, or the tickets to Disney go up. In other words, consumer prices are related to your daily consumption.
If you're looking for great deals on gold and silver coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
Now, there are also asset inflationary periods when, say, house prices go up, when stock prices go up, when bond prices go up, when collectibles go up, stamps, wines, and so forth, pictures. Anyway, the Federal Reserve and other central banks, in the ultimate wisdom, don't pay much attention to rising asset prices. They actually welcome rising asset prices because they want to stimulate growth. And when asset prices go up, it boosts consumption. Now, there are times when consumer prices tend to disinflate. In other words, after 1980, we had a period when the consumer price inflation was coming down. We still had inflation, but at a lower rate each year. And that allowed bond yields to come down and stocks to rally. And also the housing market for the last 40 years has been very strong. Now, in my view, and this is a controversial view, but in my view, the asset inflation is coming to an end. And we had already one important asset that has collapsed in price, and these are commercial properties.
Yes.
And I think what will happen next is that stocks will go down, and that residential properties will go down. Now, the Fed doesn't like that because they must know, even though they have very little knowledge or historical perspective, but they must suspect that falling asset prices would be disastrous for the economy that is so leveraged. And if asset prices go down, I can tell you, in my view, people will consume less. The wealth effect will be very high because the financial market is so high as a percent of the economy. Say in 1970, when I started to work, the market capitalization in America was 25% of the economy, 25%. Now it is 150%. So the impact on people's wealth will be very significant when stocks go down. A lot of people will be, I mean, they have already been wiped out, but more to come. And in that environment, your viewers should consider the following thought. In a bull market, everybody is prepared to position himself into things that will go up in value, say stocks mostly, and some have precious metals, but the precious metals ownership is tiny in comparison to stock ownership, and they own homes. Most people, the middle class, have their wealth in homes, the bulk of their wealth. Now, if that is coming down, I can tell you consumption will suffer very badly. And the Fed, in my opinion, is more concerned about this event of asset deflation than about anything else, because that would really kill the economy.
And would you say that this falling oil price, which we're also seeing, is that a precursor of what's to come? Oil is at a $50 handle, $59.15 at the time of this recording. What does the lifeblood of the oil is effectively the lifeblood of the economy, right? What does that spell? I mean, it pretty much backs up what you're saying here, no?
For some countries, oil is very important. Other countries, say, I'm Swiss, in Switzerland, we have no oil. We benefit from falling oil prices, in principle.
Mm-hmm.
But of course, if the Saudi Arabian Sovereign Fund and Abu Dhabi Investment Authority have no income anymore from their oil revenues, they may have to sell securities, stocks and bonds and so forth. So again, I'm not sure what the impact will be, but falling asset prices in general have been very bad for the economy, for the daily economy.
Do you anticipate this bringing manufacturing and industry back to America, like Trump intends with the plan, or do you see other effects?
I think it's a pipe dream to bring manufacturing back to America.
Yeah, because I was looking at Vietnam's, like the average salary in Vietnam is like $600 a month. Like, there's no way you can have a trade balance with a country like Vietnam if you're the United States. Like, how realistic is this? And it seems like he's already. I mean, he has rolled back the tariffs, but he's kind of leveled it off at a 10% threshold. But China, China's the elephant in the room, right? So 125% tariff on China. How do you see this playing out for the administration? I mean, will they have to completely renege on all the tariffs, or can they stand their ground here?
They can stand the ground, but what it means is that a lot of products will be more expensive for the American consumer. The tariff is a tax. There's no mistake about this. It's a very arbitrary, and it is a tax that hits the middle class and the lower classes much higher, much more than the wealthy. It's like carbon taxes are hitting ordinary people harder than the people that fly around in private jets and are exempt from carbon taxes. For instance, you understand? The rich people, and I'm sorry to say, I also belong to this group of people, but the rich people, unfortunately, are very good at protecting their self-interest, and the rich people are very good at paying no taxes or very little tax compared to the working class. That's the way the system is set up and has always been set up for the last 5,000 years of human history that is recorded. It's always been like this. Never seen a system where the poor people don't pay tax and the rich people pay tax. The whole history of mankind.
Yeah, totally.
But I want to explain to you the tariffs are very negative for the US industry by and large and in the long run, because it's in the whole discussion of tariffs, what is overlooked is the following. It's been argued, yes, that say young countries have tariffs because they want to build up their automobile industry and so forth. And to make it competitive, they have to have tariffs initially so they can start their own industries. That is true in the case of emerging economies, because at the beginning, say, a country like, I say an African country, if they want to develop their automobile production, their own, if they didn't have tariffs, the Chinese manufacturers and the Japanese manufacturers and the Koreans, they would dominate the market, and the local competitor would have zero chance to compete because he wouldn't have the volume of production that the others have. Now, in this case, I can understand the country who introduces tariffs, although there is no evidence that these tariffs accelerate the development of an industry and do not retard the development of an industry. That we don't know, but it's assumed by economists. And what economists assume, and I was also one of them, but I can tell you, I would never rely on what an economist assumes, because in the 19th century America, there were no economists, and 19th century America grew at a faster rate than 20th century America, when there were thousands of economists that all intervened into the economy and F it up. Everything what the economists do is a disaster, is a complete disaster, because most of them are Keynesian interventionists that know it all. This is the Davos crowd, you understand? They go to Davos and claim, yes, we have democracy, but they themselves want to rule the world, and they themselves want to take measures and intervene into free markets to their own advantage. That is the purpose of Davos crowd and of economists.
And it's their focus on first order effects that's their downfall.
Yes.
They can't see past their nose. Like, they can only see it so far ahead. They can't see the second, third, fourth, and nth order effects of.
Let's assume, as a general assumption, by definition, an economist is an ignorant person, especially nowadays at the Federal Reserve. There are not economists that have a broad knowledge of history and of social trends and of how a system of society best functions. What they want is to foster and enlarge their own power. Anyway, let's leave it at that. But I want to point out that it's interesting how in the last 100 years, the government has intervened more and more into the free market. If you take 19th century America, the government was not even 10% of the economy. In other words, tax revenues were 10% of the economy. Now tax revenues in the US are around 41%. And in the socialist regime of Europe, in most countries, government is more than 50% of the economy. And what have they done in Europe? I mean, this is amazing, because after World War II, Germany was das sogenannte Wirtschaftswunder, the miracle, the economic miracle. And what have the Greens and the socialists in Germany done? They managed to bring down the economy into recession. That is government. They managed to bring down a thriving economy into recession and into economic decay. I mean, it's hard to believe, but that's what happened.
Well, what is the
That's
logical?
why I say I would have voted for Trump. because Kamala Harris would be exactly the same model of bringing down an economy into a complete disaster.
Right. What is the logical conclusion of the EU and the Europeans? Because from what I've been hearing is a lot of capital is just fleeing out of Europe and coming into the United States and the UAE. How do you think? I've particularly heard about the weakness in the banking sector in Europe, but I want to get your take here, Mark.
The banks in Europe have been one of the best performing groups in the world over the last 2 years. I'm well aware of this saying that the banks are vulnerable and so forth, but the banks have performed superbly even today. And I had to laugh when you said we have to think logically about Europe because there's no logic in the markets anymore. You take, for instance, I mean, we can all see that Europe is not doing well economically, and that we have this government debt problem as well, just as we have in the US. And the economies are not growing. But it's interesting since Trump became president, the euro has been strengthening considerably against the US dollar, especially today against the yen. And what I wanted to say that the euro has been strengthening against the US dollar and the yen also. And I can tell you, there are lots of shorts outstanding on the yen. So a lot of people got very badly burned. But the markets today, and this is something I think your viewers should consider, are very illogical. And the basic view, from my point of view, or in my opinion, is over the last 10 years, there was one asset class that has practically outperformed everything else, and that is the US stock market vis-a-vis European markets and the US stock market vis-a-vis emerging markets. And so the US stock market has become, in my view, became, in my view, grossly overvalued around the turn of the year 2024, 2025. And the main reason the stock market in America is going down is that it was so colossally overvalued relative to everything else. And now the big question for investors is this. Usually in a bear market, when the leaders like the Magnificent Seven go down, it drags down everything. But there are also exceptions. Say Japan in 1989, my view, and I was wrong, my view was Japan would go down by 50% and it would drag down other markets. But no, Japan went down and the money left Japan and went into the NASDAQ in the US. And we had a tech bubble until year 2000, specifically March 2000. So it is possible that because of the continuous money printing, US stocks, don't go down a lot, but the dollar goes down. And two, it is likely that other assets will outperform the US stock market. With the US stock market, say we look at the S&P, the Dow, the tech sector is an important component of the whole index. Say tech stocks in America are over 30% of the S&P. So if tech stocks are deflated, it will deflate the index.
Right. And let's finally, before we close out, let's get your views on precious metals. Gold acted as the safe haven asset during the last week or so. We did have a haircut in gold, but from a relative basis, gold was able to outperform pretty much everything else, and it's now back up to close to 31.64 at the time of this recording. Silver's close to a $31 handle. What's your current take on gold? Is gold going to continue its precipitous rise up?
I'm a very consistent person, and I've been consistently holding gold, and I like it for the last 40 years or so. But obviously, as the price of gold is stable and the paper money depreciates, in other words, optically it looks as if gold would go up, but in reality it's the paper money that goes down. My view is that near term it is at a relatively high level. You understand? Say oil would be much cheaper than gold at the present time, or food. I mean, wheat, corn, soybeans would be very cheap compared to gold. But it's difficult for ordinary people to store, say, a ton of oil. It's easier to store a ton of gold.
Right.
It's only the size of a cube. But I don't think the price is particularly cheap. Having said that, when you go to a party, say, anywhere in the world, and you ask people, well, what do you do with your money and so forth? And then you ask them, do you also own any gold? And then, of course, the wife says, yes, we have gold and so forth. But when you dig down into how much they own, I tell you, most people don't even own 1% of their wealth in gold, not even 1%. And financial institutions, the mutual fund industry and the fund managers of sovereign funds and so forth, if they have 1 or 2%, that would be the maximum. So my view is the world is grossly underweight precious metals. And by the time this bull market in precious metals, or I'd say the bear market in paper money value, and I think the paper money will go down to zero value. By the time it's over, the world will own gold to a heavier amount. I've seen in the 70s, I remember the typical portfolio allocation was to have 10% of a client's money in gold. That hasn't happened yet. 70% of financial institutions in the US, they own less than 1% in gold.
Yeah, so reversion to mean, so to speak. Well, it's been a pleasure having you on, Mark. Anything else you want to talk about that we didn't get into in this interview before we wrap up?
Well, I'd say this, in life it's very difficult to plan because you don't know much about the future. But the difficulty is compounded by bureaucrats that intervene into the market who are clueless. And I'd say this administration in the US consists of largely clueless people. And they intervene in a way that is more pronounced than previous administrations. So you will have these swings in the market like yesterday. The market was down and suddenly it shot up. But of course, when it was down, I had an interview the previous day. I said the market is very oversold by the technical indicators and the rebound is coming. But I didn't expect a rebound of this magnitude.
Yeah. The Nasdaq went up 12%. Go ahead.
Yes. And I mean, some stocks, they went ballistic. But I think it's important for an investor to say to himself, I don't know what will happen. So I want to be diversified, and I don't want to be overly exposed to something, because the markets frequently, as you pointed out, or I pointed out, that they have no logic. They move, the events are such, but they move in a different direction than you would have expected. So I think that I'd be very careful from speculating heavily in one or the other thing. But as I said, if you want something really safe, I think an exposure to precious metals is advisable.
Yeah. So a logic in an illogical world is illogical. Well, thank you so much for coming on, Mark. Where can people find you? Tell us about the Gloom and Doom report.
We have a website, gloomboomdoom.com, all in one word. At the bottom of this picture, you have it's all gloomboomdoom.com.
All right, gloomboomdoom.com, guys. The link will be in the description box down below, so be sure to check it out if you're interested. Also, like and subscribe so you don't miss another episode. Right, go, Mark, go in the comment section if you agreed with Mark's commentary. If you disagreed with anything, that's okay too. I do read the comments, so drop me your thoughts. I do read the comments. Also, check us out on Substack. It's capitalcosm.substack.com, where you can get early access and ad-free versions of all of my videos, as well as uncensored versions to the videos that warrant it. And then finally, check out our good partners at Pimbex. It's PIMBEX.com for all of your gold and silver buying needs. All right, guys, thanks for watching, and I will catch you in the next episode. Bye.
Thank you very much.